You trust your bank with your money, right? I mean, it's your hard-earned cash. But what's really stopping them from, I don't know, gambling it all away? Well, today we're going to pull back the curtain on the essential global rules that are supposed to keep the banks in line.
It's a really simple question, but one with absolutely huge consequences. Because, when banks fail, it's not just numbers on a screen. We're talking about your savings, your mortgage, your entire future.
A big banking crisis, it's kind of like an earthquake. The tremors just ripple out and shake the whole economy. It can topple businesses, erase jobs, and shatter the nest eggs of millions of people. And that's exactly why we need a global system of checks and balances. So, to try and stop these financial earthquakes before they even start, countries all over the world have agreed on a common playbook, a global rulebook for safe banking. So who actually writes this global rulebook? Well, it's a powerful but kind of obscure group called the Basel Committee on Banking Supervision. Think of them as the top banking cops from around the world, and they meet at this place right here, the Bank for International Settlements in Switzerland. And they do not mince words. They call their creation the Core Principles for Effective Banking Supervision. And it's basically the absolute bare minimum standard for keeping the world's entire financial system from falling apart. And listen, this isn't some flimsy pamphlet. We're talking about 29 super detailed principles that cover everything you can think of, from who's allowed to own a bank to how that bank should handle a major cyber attack. It's pretty much the DNA of a safe bank. The easiest way to get your head around this is to think of it like a really high-stakes sport. The 29 principles are basically split into two parts. You've got the rules for the referees, those are the national supervisors who enforce the rules, and then you've got the rules for the players, the banks themselves. So let's start with the referees. What kind of powers do they actually have? What's in their toolkit to keep all these banks in check? According to the rulebook, these referees have some serious muscle. They're the gatekeepers who decide who even gets a banking license. They're the watchdogs who are supposed to be monitoring banks constantly. And if a bank breaks the rules, they can blow the whistle, throw a penalty flag with sanctions, and even kick them right out of the game by revoking their license. I mean, think about it. If you wanted to start a bank, you couldn't just hang up a sign. The referee would put you through the ringer. They check where your money came from, if your CEO is a trustworthy person, and whether your whole business plan is solid or just a house of cards waiting to collapse. But here is probably the most important rule for the referees. They have to be independent. They can't be swayed by powerful politicians or banking lobbyists. Their only job is to protect the system, not play favorites. Okay, so we know what the referees do. Now let's flip it. What about the players? What are the rules of the game for the banks themselves? The rulebook says it all starts with having your own house in order. That means having clear leadership, so everyone from the board of directors on down knows who's responsible for what. And it means having a solid game plan for dealing with all the things that can go wrong. And trust me, banking is a minefield of risk. You've got credit risk, what if people can't pay back their loans? Market risk, what if the stock market crashes? Liquidity risk, what if everybody wants their money back all at once? And then there's operational risk, what if your systems get hacked? Banks have to be prepared for all of it. So with all those different risks, how do banks protect themselves? Well, the rulebook has a simple but really powerful answer: a capital cushion. Banks are forced to set aside a huge pile of their own money, a massive rainy day fund that's there to absorb losses so that one bad bet doesn't sink the whole ship. So, okay, we've got the referees and the players all following this global rulebook. But why should you really care about any of this? How does it actually affect your life? Well, because this rulebook is basically the scorecard that major global institutions like the IMF and the World Bank use to grade entire countries. They literally send in teams of experts to see if a country's banks are playing by the rules. And getting a good grade, well, it's like a 5-star review for a country's entire economy. It attracts investment, it fuels growth, it creates jobs. But on a really personal level, it means you can sleep at night knowing the bank that's holding your life savings is being held to the highest international safety standards. But the rulebook itself gives us a big dose of realism here. The goal isn't to create a world where no bank ever fails. I mean, in a free market, some will. The real goal is to make sure that when a bank does fail, it doesn't cause a domino effect and take the whole system down with it. And that brings us to the billion-dollar question, doesn't it? The world of finance is always changing. New technologies, new kinds of money, new kinds of risk. And the rulebook is constantly being updated. But can it actually keep up? Is this global safety net strong enough to catch us the next time a crisis hits? That's the question that keeps regulators, and probably all of us, up at night.